We're going to spend the next 15 minutes or so going through some of the updates of what you need to know, and we'll leave some time for questions and answers. And for what questions we don't get to, we will be sure to reply after hours here. Today's agenda includes going over the bill that was passed at the end of the year here, which encompasses PPP update, and then we'll leave time for questions. The first big thing, like last time, if you joined back in April when the CARES Act was passed, this probably looks pretty familiar to you. You can see the cutoffs of these latest rounds of rebate checks that were sent out or should have been sent out. And basically, the dollar thresholds are pretty, just about identical to last time. Depending on if you have dependents, if you're single, you can see about $75,000 for single people with no dependents, $150 married with no dependents, and it kind of scales a little bit from there. So those should have been mailed out to people. You've probably been receiving them or direct deposit them in your bank account. As a reminder for these rebates, they are an advanced credit for 2020. So the good news is basically on the new 1040 forms, they can't come back and claw back. In other words, if your income went up a lot more in 2020, but you qualified based on 19 or maybe even based on your 18 tax return, you are not going to get penalized for that. There's no clawback. And maybe on the other hand, if your income dropped down a bunch compared to 19, you may be eligible for more. And where that would show up is, with your tax preparer on the tax return, you would get credit for an initial amount if your income dropped year over year. And as a result of that income drop, you could potentially get the full amount in 2020 on the return. So that's where you'll see that, which is an important point to keep in mind. We've had some questions on unemployment and compensation. These rebates are not, as I said, they're not taxable income. The rebates are a credit that offsets your taxes. But unemployment compensation, that is taxable income. So that is a difference there between those two things if you are in that situation where you may have both of those things going on. You may also be getting, some customers, these rebate debit cards. I know the IRS has mailed out some of these things. And so what I wanted to show you today was what this might look like in the mail. If you receive this, I know this is a way they've been sending out these payments to certain individuals as well. So just be aware that this is something like this comes in the mail, not to throw it out, because it could have a debit card in there with your rebate from the last stimulus bill. One of the big changes that occurred at the year end that I think most people are familiar with was the change in the PPP tax deductibility. So if you remember this roller coaster from when the PPP first rolled out, there's a lot of uncertainty with regard to how it would all play out. For example, we all knew that they were going to forgive the amount of the loan as long as you met certain criteria, but we weren't really sure about what were going to happen with the expenses. And back around Thanksgiving time, the IRS came out and said you can't deduct the expenses. So, in other words, it's sort of like it was taxable, because if you can't deduct expenses, your income goes up, in other words. The good news here is that Congress, at the end of the year, when this bill was created and passed, made those expenses deductible. So that it was a big relief. So a lot of your tax planning probably changed for the better. There's still tax-free forgiveness. There is some uncertainty across the states here, across all states, with regard to how each state is going to treat the PPP tax-free stuff, because every state has different rules on whether or not they comply with federal rules, they don't comply with federal rules. So just be aware of that. Like anything else that we present from a federal perspective, there are and could be state nuances that interplay with it. So giving an example of what I just said, let's say a taxpayer received $50,000 of PPP in 2020. They used it on all eligible expenses. Let's just say, keep it simple, it was all eligible payroll expenses. That loan was forgiven in 2020. So what does that look like? Well, the expenses would be deductible in 2020. And when that loan was forgiven, canceled in 2020, it's not going to be income. So a really nice outcome all the way around federally for a taxpayer under the new rules that got passed at the end of the year. Let's just compare that to a similar example, but I'm sure probably a lot more people haven't got the PPP forgiven yet. So in this case, somebody received 50 grand of PPP in 2020, but they're going to get it forgiven in 2021. The expenses are still going to be deductible in 2020, but you'd have at the end of the year probably book a loan. In 2021, once that forgiveness comes through from SBA, that's not going to be income in 2021. So same outcome, whether or not you get it forgiven in 2020 or 2021. And again, good news all around for taxpayers as far as getting both the expense and the tax-free on the back end, so long as, again, with the caveat being you followed all the rules to get PPP forgiveness that we've been talking about over the last several months on how to navigate that with our team. And you may have heard Keith Dickinson and Aaron Piro on several webinars there. But as long as you're following the rules, it's all forgiven, no income there. So good stuff there, really good stuff. Another big change that happened at the end of the year was with regard to net operating losses. So net operating losses, essentially now with farmers or losses derived from farming, we really have three options here. Farmers with their farming losses can carry it back 2 years, 5 years, or carry it forward. So this is an example of, right, let's say somebody lost $100,000 on their Schedule F, and once you're looking at the return, maybe it's available to carry back. This is what this is referring to. Can it go back and offset other income from prior years? Farmers have a lot more leeway compared to other taxpayers with regard to how these net operating losses work. They also can be carried forward. And this is really an area where I would say it does take some thought on how to optimize these things because, again, there are state differences and there are certain ways to optimize net operating losses. And it's really important to, if you have one of these on the return, you may get questions from your tax preparer saying, hey, how do you want to treat your net operating loss this year? You got one. Do we want to carry it back 2 years, 5 years? And obviously that would depend on what your tax situation looks like over the last several years or what it may look like in the future. And so it does take some planning and some discussions with your advisors to figure out the best thing to do with this. But the good news is this latest bill gave more flexibility again to farmers with your losses incurred in farming to be able to do pretty much what you want with them. It's just a matter of working through what the best scenario may be. So moving on now to a broad overview of the second draw PPP is how it's being phrased out there in the literature and in the bill. It's really similar to PPP1. And we're looking at, when I say that, right, 2.5 times your monthly payroll. We got that. Remember, we had that higher income employee cap of about 100 grand, and your payroll, they're going to let you look at either 2020 or 2019. So the lesser of those amounts, or $2 million. Really similar. If you've gotten PPP1, you're probably pretty familiar with this calculation. The only tweak there is you can look at 2020 or 2019 average monthly payroll, right? 2.5 times that average monthly payroll. You have a little bit of an option to pick what you want to do. So that's pretty nice. And the reason for that is they were thinking that instead of using the 12 months prior to the loan date, they would just let people use 2020 to make it simple, to say, okay, can we somehow make this a little bit easier for people to follow and to take it into there. And so that's why they're saying just use 2020 if you want, or use 2019. So keep that in mind, that it's a lot simpler, and there's a little bit of an option there on what average monthly payroll somebody can use in order to obtain PPP round 2. As far as the expenses go, again, really similar towards last time. A high-level overview here. Remember, we got our payroll costs, owner compensation, certain rents, utilities, interest. We got that 60-40 split where you got to use at least 60% on payroll costs, and you have 40% on other stuff. You will notice refinancing an SBA EIDL loan, that's in there too. We'll talk a little bit about that in a couple slides here, but those rules have changed with the EIDL loans where they're not going to count against your PPP forgiveness and all that good stuff. So that's another piece of this round 2 as well. But again, big picture, really similar with regard to what expenses are eligible for round 2. The only difference, they've actually expanded on some of the non-payroll costs that you can utilize. And you can see them on your screen there. There's 4 new criteria that they've allowed. Covered operation expenditures, covered property damage costs, covered supplier costs, and covered worker protection expenditures. And those things are all defined, for example, operational expenditures would include things like business software or cloud computing services, things that track payroll, maybe your sales and billing function systems, that type of stuff. With regard to property damage costs, those were costs related to the way they termed it was vandalism or looting due to the public, all the stuff that kind of went on this in 2020. So all that stuff that was going on in 2020, if a business was damaged because of that type of stuff, that would also count if you were damaged as a result of looting or vandalism. Supplier costs, again, think of just things essential to the operations that are that you're purchasing supplies and goods for, kind of self-explanatory there. And they've added worker protection expenditures, which is things like stuff to comply with COVID guidelines. So if you're making capital expenditures to retool your business to become in compliance with some of these health mandates that have come down the pike, that's what that refers to. So they've actually added onto what you can count as a qualified expenditure. Now, anecdotally, I would say our experience has been most people spend the PPP money for the most part on all their payroll anyways, and that covers it. But if you're also spending it on the other stuff, they've also now expanded the other stuff pool to include these 4 things that you're looking at. So what are the criteria to get the second draw loan? This is probably what is most important to people. There's an employment limit of less than 300 people. For by and large, most businesses. There are some exceptions there that are out. You're probably not really applicable to people on the webinar today, but you think of that 300 number as your threshold. There's a 25% gross receipts reduction, and that reduction compares 2020 to 2019. So basically you could look at your 19 as a whole compared to your 20 as a whole, and if you've got reduced receipts by at least 25% there, you would qualify. They've also put some stuff in there to say, well, if that doesn't work, maybe you can look at it quarter by quarter. So maybe you look at Q1 in 2020 compared to Q1 in 2019, and so on and so forth down the line to see if you have one quarter that compares to another quarter that can make you qualify as far as that 25% gross receipts test. You've had to have received a PPP-1 loan, and you've had to have used or will use that loan on eligible expenses there. So keep that in mind. And the full amount of PPP-1 loan will include things, as we'll talk about here in another slide, if people potentially refinance their round 1 loan, because now some people can go back and get more money for round 1, that would count towards that thing there. And they want to make sure, obviously, that people have gotten round 1 and they've spent that money on all the stuff, all the eligible expenses before getting to round 2. One thing to note for some people with multiple businesses is that you really got to, again, work with a good advisor, because there are aggregation rules. So as we're thinking about these gross receipts tests, for example, if you have business 1 and business 2 owned by spouse A and spouse B own business 1, spouse A and spouse B own business 2, aggregation rules could make you basically look at the whole thing as a whole to see if you've met that gross receipts test reduction or not. So be aware of that there are aggregation rules. They look at kind of all your stuff holistically, and it can get kind of complicated there. So, but just be aware that if you have multiple businesses, that aggregation rules are out there that do impact what's going on. So the next question that you might have is, well, what are gross receipts? Basically, I would say simplicity, think about it, is all your stuff on the return, all the income coming in on your tax returns, They have some exceptions in the rules there into the regulations for not counting capital gains in certain cases there. But by and large, think of it as everything, all the stuff on the return, in accordance with your accounting method. So obviously, if you're a cash basis taxpayer or if you're an accrual-based taxpayer, your gross receipts would be different depending on what accounting method you're using. The important thing to keep in mind here is that if you've gotten forgiveness with PPP1, that is not includable rather in your gross receipts. So they're not going to count that forgiveness amount in gross receipts, which is a nice boost for people that do not count that. If you got a $200,000 PPP loan in 2020, you had a forgiven in 2020, they're not going to count that $200,000 since it's tax-free money. They're not going to count that as a gross receipt. So that makes sense, but that's they made that clear in the rules and regulations. So what have they done for farmers here, people with Schedule Fs? They've actually allowed the rules to be a lot more favorable because farmers can use gross income now to do a few things. As we understand it as of today, they can use gross income to apply for PPP1, to increase their loan for PPP1, with the exception of unless that PPP1 loan has been forgiven already, and apply for PPP2, if eligible, obviously. So if you meet those criteria as a farmer for PPP2, and you hit those 4 criteria with the gross receipts being the big one there, you can use your gross income up to $100,000 now. So that's what they've kind of done. They've said that as long as you have $100,000 of gross income, basically as a Schedule F farmer, that's going to be what they base it off of. So think of, for example, maybe you're a Schedule F farmer with $10,000 of profit that you applied for last time, but you had $200,000 of gross income on your Schedule F. They're now going to let you use that $100,000 of gross income to calculate your PPP loans. And the max there would be $100,000 divided by your 12 months times 2.5, $20,833. So really good news there as far as how they figure out farming PPP loans. And it's based on that $100,000 gross cap there. So really good news for farmers in this area. There's a slight gyration there for farmers who have employees, a little bit different calculation where you got to do some backing out of your employee costs. But again, simplistically, as long as your gross income, if you're a Schedule F farmer and you got employees, if your gross farm income is at least $100,000 more than your employee expenses, you're going to get the max amount there potentially if you go back and get more stuff. So really good news there. I think this is going to be potentially a benefit for a lot of people, and we'll have to navigate that. Moving on to the economic injury disaster loans, the EIDL. If you recall, this was part of the SBA stuff where they expanded this for farmers as well. The way they ended up interpreting this was they had those tax-free grants, if you recall, up to $10,000 per business, $1,000 per employee is how they ended up finally interpreting that. The good news is with this bill that got passed in December, those grants now that if you had 10 employees, you got $10,000 EIDL loan, that's a tax-free grant now. So it's tax-free, not going to be income to people. Good news there. The other good news is that if you recall the last go around, they wanted people to make their PPP forgiveness application and loan be reduced by the up to $10,000 of the EIDL amount. That's not going to happen anymore. So they got rid of that piece of that to make it a little simpler for people in doing their forgiveness stuff. They've extended these EIDL loans through 12/31. Remember, these loans basically were, I think, 3.75% interest rate for small businesses. And it was some people applied for them now because they expanded those to be farmer eligible. And those loans are for things like working capital, operating expenses, et cetera there. We're going to talk a little bit now about the employee retention credits. So a lot of people ignored this, and rightfully so, the last go around back in March when we got this PPP stuff, because the bottom line is here, for people that got PPP loans, the employee retention credit was not an option to take. But this latest bill got rid of that and said that, okay, even if you got PPP loans, we are going to let you take the employee retention credit so long as you meet certain criteria that we're going to get into. But the thing to keep in mind here is that with a lot of these different provisions, there's no double dipping on the amounts there. So you can't use the same 10 grand, let's say, wage for an employee to get PPP forgiveness and that same 10 grand wage of that employee to get employee retention credits. But if there's different wage amounts that you use for that employee, that's okay. So just keep that in mind. There's no double dipping as we talk about the rules here for the employee retention credit, because this will become, for some people, now that we can go back and get it, some people will qualify for this stuff. So the first thing is, you can see at the top of the slide here, in parentheses, it says old. So we're going to talk about the employee retention credit in two different frameworks here. The one framework is from March of 2020 here through the end of 2020 is, think of that as the ERC, the employee retention credit, the old rules. And then we're going to have the ERC from January 1st through June 30th as that second bucket. So we're going to talk here about these rules as they were originally constructed, because now we can go back and get these. Basically, an employer could get 50% of wages per employee up to 10 grand. So think about it as 5 grand per employee under these rules in 2020 for wages paid. Qualified health expenses count, and there's a lot of rules associated with that, of what counts for plans, what doesn't count for plans. Basically, qualified health expenses wouldn't count after-tax contributions for the employees, but the pre-tax stuff for a qualified group plan for the employer and the employee would count. And so what would qualify you as an employer to get this? One of two things. Your business was interrupted by the government. So think about it as you were shut down, maybe, or partially shut down. A simple example would be, you run a pub and your pub was shut down because you couldn't serve people, or maybe you can only do curbside pickup. That type of stuff is what we're getting at with your business was interrupted. Or the other criteria is you had at least a 50% gross receipts decline. So you have to have one of two things happen to qualify for the employee retention credit. Either your business was interrupted by the government, or you had a gross receipts decline of at least 50% there. And most core production farms were essential, so they weren't shut down. So I would say most people would have to qualify under the 50% gross receipts test. I'm going to say, again, they did have some reason why your business here was shut down partially or wholly by the government, in which case that would qualify you. And just a short plug there on, depending on whether or not you have 100 employees or not, I would say most people probably on the call have less than 100 employees. But if you're over that, there are slightly different rules in order to figure out what qualifies for costs for eligible employees. And what's an eligible employee? Full-time employees, you get into at least 30 hours of service per week or 130 hours of service per month there. So there are some rules there that you have to work through, but keeping it simple, if you had under 100 employees, you either had to have, if your business was interrupted, so you were closed by the government, partially closed, or you had that gross receipts test. And so what would that look like from a gross receipts test of more than 50%? You'd compare your Q1 or any quarters compared to 19 versus 20. So you can see here in Q2, this BKM Farms LLC, gross receipts were taking a hit, 40 grand in Q2, 75 grand Q3. It basically would continue on until the end of the quarter, after which you got back up to a certain threshold of 80% gross receipts compared to 2019. So for example, in Q4, we've gotten kind of back up to a healthy amount according to the rules. So it will still be available to it, but it would end there. But let's say in this example, in Q3, you had for 2020, you had 100 grand of income in 2020 in Q3. You would not be eligible in Q4 because you got back up to that amount there. So in this example, we would qualify, this BKM Farms would be eligible for Q2, Q3, and Q4 because their gross receipts took a big dive of at least 50% in Q2, and that went on through Q4. So in this case, we would get, again, up to that 50% per employee, so 5 grand potentially per employee for those durations there. pretty good credit. So, right, this is a pretty healthy credit if you qualify for it. These are not small dollars. So it really does, now that this qualifies with PPP, and again, the caveat being here that you can't use the same wages for PPP payroll and and employee retention credit expenditures. But otherwise, you can get both. So that's a big change, and we got to be aware of that. It gets even better now with the employee retention credit as far as 2021. So this is where I mentioned earlier that this is kind of the quote unquote new employee retention credit. So what have they done? They've extended the employee retention credit through 2021, basically for the first 2 quarters. So, basically up until July 1. So it ends 6/30 there is where you look at the new ERC. They've increased the credit amount from 50% to 70% of wages. So think of it, if you had 10 grand, it would now be for that employee $7,000 of a credit, not $5,000 of a credit. What they've also done is increase qualified wages for it's up to 10 grand now per quarter. So under the 2020 ERC, it was a 5 grand max per employee total. Now under this ERC for 2021, it's 10 grand per quarter. So, right, think about it. If you qualified for the 2 quarters here, and you had somebody making 10 grand in quarter 1, employee, 10 grand making they made in quarter 2, they would get 7 grand each quarter. So that's on that 20 grand of wages, that's $14,000. That's a lot of cash. And so they've made this even more lucrative for people who qualify. And they've actually made it even easier to qualify because their gross receipts decline. It was in 2020, as we just got done talking about, 50%. Now it's got to be basically, you've had more than a 20% decline. So they've made it a lot shorter and smaller to qualify for it. So 20% compared to 50% is a big reduction on getting that bar lowered as far as qualifying goes. So what would that look like? So we would compare, again, we're going to compare the first quarter of quarter 1 and quarter 2 of 2021. We're going to compare this to 2019. And the reason why they did that was because it's likely for employers that your business was higher in 2019 for Q1, Q2 than 2020. So they're doing people a favor by making the quarter look back to 2019 year. So you can see on this same farm for Q1 and Q2 of 2021, they're 70 grand of receipts in Q1, 75 grand in Q2. This farm would qualify. And so then you would look at how much you paid employees during those quarters, and you'd go through that gyration of getting up to 70%, up to 10 grand per quarter per employee, back as a refundable credit. These are huge dollar amounts. Again, going back to that example of you had an employee making 10 grand in Q1 and 10 grand in Q2, you'd get $14,000, 7 grand in Q1, 7 grand in Q2. So depending on how many employees you have, if you qualify for this, these are pretty big numbers. And so we got to make sure that we understand the employee retention credit. We got to go through the calculations, and we have to make sure that we either qualify or don't qualify for it, because we do not want to leave money on the table for the employee retention credit. There's also a special rule there. If some people couldn't qualify, you can make a special election under the rules, it appears, where you can look at the preceding calendar quarter. So for example, maybe you couldn't qualify under the prior example that I just showed you, but if you looked at Q4 of 2020 compared to Q4 of 2019, maybe you qualified. So there are special rules there that people can look to if they don't qualify under the normal rules to figure out whether or not they qualify for that 2021 employee retention credit. I suspect there'll be more guidance coming out with regard to this calculation, because one of the questions is, if you make the election, are you then stuck with it for Q2 in 2021? The answer is probably yes, sir, but I don't know. We don't know yet. We'll have to wait for guidance as we get more from the IRS in this area. But the big thing to be aware of for right now is that there is a certain election you can look to figure out whether or not you qualify for the employee retention credit. So putting it all together to look at a comparison of how the ERC looks from 2020 to 2021. The old ERC went through 2020, so right through 12/31. It was a 50% credit amount up to $5,000 total per employee. And the gross receipt test was a 50% reduction, more than a 50% reduction compared to 21 of more than the 20% reduction in 2021. You can see the credit bases are different there. Again, $10,000 per quarter is a lot more than $5,000 total per employee comparing the two. The new employee retention credit goes through, again, the first 2 quarters of 2021. And this is allowed with PPP, but again, on different wages. So we got to keep that in mind. So if you qualified in 2020, how do we go back and get this? There was some guidance on the IRS FAQs, the facts and questions here on when this stuff first kind of rolled out, which was, it appears that maybe we got to go back and amend 941s, 943s. Maybe they'll let us kind of true it up. Again, I don't know if that would be the case. Probably more guidance there would be forthcoming. But from what's out there today, from what they've had on the websites there, it would require some maybe amendments of the 941s, 943s to go back and get the 2020 ERC. But the bottom line is that the first thing that you need to do is figuring out whether or not you qualify based on these tests, and then based on what you use for PPP for payroll compared to the employee amounts you spent for the ERC. A few other things to note. The amounts paid that are exempt from Social Security and Medicare taxes are not eligible for this, the way they defined it. We saw this again, if you recall, with the Family First Corona Response Act credits with the sick leave and family medical leave stuff that we talked about back in April here. And this could be a detriment for some people, because you think about if you got done going through the COVID stuff, we had people who qualified for or who took sick leave because of the COVID and the rules that changed there. If they were H-2A, for example, those people didn't count. The way they defined wages to be wages that are subject to self-employment tax. So that's important to be aware of there. There's also some related party rules in these things where if you have your brothers, your kids, nieces, aunts and uncles, they defined a whole slew of related people. We just got to be careful that we're not taking these credits on people who are related, as they've defined that as such in the rules there. So again, just we see that a lot into the tax rules, where they put a lot of related party rules into a whole bunch of stuff. Tying in the employee retention credit, kind of big picture of the interactions and interplay with other stuff. So remember, now this is allowed with the PPP, although on different wages. It's not allowed with the work opportunity tax credit. And the WTC is, if you're familiar with that, it basically provides tax credits for employers who hire certain people that are maybe that have been not working for a while, certain veterans, people on supplemental nutrition programs there. So there's a whole bunch of criteria of a category of employees that you could hire under the WOTC that they want to try to incentivize. And so that's what the work opportunity tax credit is. But again, no double dipping as far as that goes. This is the employee retention credit is allowed with those FFCRA credits. So remember that COVID, sick leave, and medical leave stuff. But again, on different wages. And for some family medical leave stuff, Section 45S there, again, you cannot use the same wages here. So the bottom line is, if you have a whole bunch of interactions, if you have PPP, you qualify for the ERC, and then you also paid COVID wages, you got to navigate a whole kind of slew of dominoes to make sure that you're not double dipping on all of this stuff, because we just can't double dip on what's going on here. How does this interact with if you do get the employee retention credits? You have to let your tax preparer know, because the employee retention credit is going to reduce the expenses taken on the tax return. So they're going to let you get a credit for the ERC, but it's going to reduce your eligible expense on the tax return. And that's because the way they've interpreted the rules, the credit that you're going to get is not included in income. And so in order to not have a double tax benefit, they make you reduce the expenses there. So there's a little bit of gyrations of calculations that your tax preparer will need to do in this area if you do qualify for the ERC. So the most important thing is to just let your tax preparer know that you receive the employee retention credits. And so that can be handled properly on the tax return. It's similar if you've taken, for example, the research and development credit, kind of works similarly in that sense, where the R&D credit, they give you a credit, but you have to then reduce your expenses. So kind of similar in that fashion with the ERC. So I want to turn it over here for a minute to John Caltabiano, who has been leading the charge with our Paycheck Protection Program, just to give you, from Farm Credit East perspective on what's going on as far as forgiveness, and to stay tuned on what's coming on the pike here. So, John, if you want to unmute yourself and maybe say a couple short words here for those on the call.
Sure. Thank you, Dario, and thanks to everybody for tuning in. As you can imagine, Farm Credit East's PPP team is reviewing the voluminous amounts of technical and procedural information relative to the new PPP or recently enacted PPP changes. I would say so far from what we see, it's pretty clear that for most people, people and businesses that received a PPP loan under the 2020 provisions, you'll want to go to the same lender if you're going to pursue any changes or new PPP loans in this next go round. So that's one thing we do know is pretty clear, because there's specific provisions that say that increases, things of that sort must be done by the lender of record. So that will be one bit of advice we could share with you right now as you think through this. The other thing I would say is as I said, we're reviewing this information, and our intent is to, like we did through 2020, is try to get the information right, try to get the processes and procedures right, and then provide the information. And so we'll be contacting Farm Credit East customers here in the coming days, and we'll be providing more information once we feel we're ready to do that. So stay tuned. We're reviewing the situation, and we'll also be providing updates to our website as well. So that's it, Dario.
Hey, thank you, John. So let's move on here as we wrap up some of the few other things that are noteworthy in the bill here. There's always been these things, they're called tax extenders, and every couple of years when there's a budgetary bill or things, a lot of tax credits expired and they got to get renewed, and so there's a whole bunch of stuff that was part of this tax extender piece of the latest bill that we'll talk about now. So we're going to first talk about what's been made permanent. The Craft Beverage Modernization Act, basically what that is getting to, if you're an alcohol beverage producer there, if you recall, the excise taxes were reduced under previous legislation. All those excise taxes, that has been made permanent, those reductions there. So if that was applicable to you, be aware that that's been made permanent. The 7.5% adjusted gross income AGI medical expenses, that relates to taking an itemized deduction for medical expenses, so long as those expenses are greater than 7.5% of your adjusted gross income. That was set to expire and go back up to 10%. So they've kept that lower threshold there for people that incur significant medical expenses to be able to help them itemize. With voluntary firefighter state benefits there, basically they've made that permanent, where certain voluntary firefighters get basically some tax favored items at the state levels there for benefits. And so they've made that also permanent, along with some modifications to a lot of energy efficient things like commercial buildings and a whole bunch of other energy credits. Those things have been made permanent for energy efficiencies, as we'll talk about here as well with 2021 stuff that's been extended here. Also more energy credits. So things like there's a credit for a two-wheeled plug-in electric vehicle. That type of stuff is what I'm getting at with these extenders through 2021. People involved with the racehorse industry. There's always been this 3-year racehorse as far as depreciating it for certain racehorses 2 years old or younger, and that's been extended as well. So people that take depreciation on racehorses. Your private mortgage insurance for people that don't put that 20% down typically have what's called PMI insurance on their mortgages. That's been allowed to be extended to allow people to also, if they're going to itemize, include that into their calculation there. So that's good. And they've also, for health coverage tax credits, that's been extended also through 2021. What's been extended through 2025? A few more things have been extended here through 2025. The employer paid student loan income exclusion year. So this is kind of a big one that's been making its way through the news, where if you recall in the CARES Act, they allowed employers to make tax-free payments up to $5,250 per employee between March 27th and December 31st of 2020. That's now been extended. So, simplistically, employers who are paying student loans off for their employees, that would be tax-free to those employees, and the employer gets a tax deduction, which is great. So it's really a good program. I would just say, if you're thinking about doing this, make sure you talk to an advisor. You probably got to, I would say, draft up a written plan as part of the rules there. So you talk to an attorney, but you're going to want to have a written plan in place to figure that out, because there are rules surrounding that as far as making sure you're doing it properly in case you get audited. But the good news is, if you get a plan in place and you offer this program to your employees, they can get tax-free money. So as we think about labor being a constant strain on our businesses, it always pops up as an issue for retaining and retention of talent. This might be a way to help offer a benefit that gives the employer a tax break while also giving the employee a tax benefit. So really, really good stuff there. The work opportunity tax credit, as I mentioned a few slides earlier, that's also been extended through 2025. Again, the WTC is encouraged for businesses to hire people who are receiving government assistance or who meet certain criteria. And there's a sliding credit from about $2,400 up to just under 10 grand for certain targeted groups, people that receive SNAP benefits, people that have been on assistance, welfare, maybe people that are qualified disabled veterans or former felons. There's a whole list of people that if you Google on the IRS website the work opportunity tax credit, you can see a list of people that would qualify under those rules. The CFC look-through rules have also been extended there. Again, probably not widespread for people on this call. Those deal with international provisions of the tax rules. So, for example, if you're a taxpayer that owns a wholly owned, let's say a Canadian company or a Mexican corporation, that would be called a controlled foreign corporation. So there are rules there that have been extended as far as that goes. I would say if that applies to you, you'll talk to your tax preparers there, because it's the international rules over the last couple of years have changed pretty dramatically in that area. Discharge of principal residence indebtedness, that has also been extended through 2025. So basically what that's referring to is if your lender forgave your mortgage on a principal home, the general rule in the tax code is that unless an exception applies, you're paying tax on whatever the bank forgives on a loan because you don't got to pay the loan back. So they've allowed that up to a certain dollar amount there to be included as tax-free under that discharge of principal residence indebtedness provision. A few other things as we wrap up before Q&A here. They've extended for 2022 the meals deduction. If you've read this in the Wall Street Journal or other places, they call it the 3 martini lunch deduction, where You can deduct 100% up to your business meals for 21 and 2022. So they're trying to incentivize people getting back out, I think, is why they did to restaurants, and to kind of help get a boost to the hospitality industry. There's a charitable contribution amount here, and this is for 2020. If you recall from the CARES Act, for people that don't itemize, you're going to be allowed on your 2020 tax return a $300 above the line deduction for charitable contributions. So if you take the standard deduction, let's say federally, but you've also given $500 to your church or place of worship, you get a $300 deduction on your front of your tax return there, which would save you whatever your marginal rate is. So if you were a 30% taxpayer, your rate would save you $90. That's gone up to $600 for 2021. So they bumped up that provision as well. If you're an educator, so the tax code has historically had a place where if you spend $250 on stuff as a teacher, for example, you get a deduction for that on your tax return. They've included in that your personal protective equipment in that supply. So if you had to buy face masks and things of that nature, that would qualify if you're an educator. The FFCRA leave credits. So again, the family leave and the sick leave stuff that I mentioned a little bit earlier, they've extended those credits through March 31st. So even though you're not required as an employer to offer that program in 2021 year, if you choose to keep paying those for people, those credits are still out there for you to take. So if you decide to kind of keep doing that on your own, those credits will continue through the first quarter here in 2021. A really great resource hub, as Chris mentioned at the beginning of the program. If you go to our website, Knowledge Exchange, you can see the webinar list there, and you can see our COVID-19 resource hub. That's where we have all resources regarding to PPP changes, legislative updates. We have links to the SBA rules and PPP rules there. So we keep all that information in one spot that's handy for everybody to access on our website. So I would strongly encourage you to use that. It's a great resource. You can see also there that the Tax Talks blog that Chris mentioned too, that's where we post things on a monthly basis on all different types of tax provisions and things that are important for people to know. So I would encourage you to sign up for emails for our blogs, because we are putting out, as things roll out, updates to all this stuff. And like the last time there, and as John mentioned, we're going to continue to have probably SBA and tax guidance that comes out where the IRS keeps changing the rules, SBA keeps interpreting the rules. So stay updated through our Knowledge Exchange materials on our website to keep you up to speed on what's new as things roll themselves out here. So I think, Chris, we're kind of right on time to leave 10 minutes if we need it for questions here, and try to take any questions from the audience on what's on people's minds. I will do my best to answer them. If I don't know, I'll tell you I don't know it, but I will try to find out for you.
Okay, great, Dario. We do have a few questions that have come in. First, before we begin, I'd like to mention that today's webinar is being recorded and will be posted. All of our webinars, past, present, and future, are accessible at farmcredities.com/webinars. So if you want to listen to this again, or have someone else in your organization, or refer a colleague to this, this recording will be posted by this time tomorrow. And that's the case with all of our webinars typically. So to ask you a few questions that have come in, Dario, here's an accounting one. What would be the proper accounting entry to book a PPP loan forgiveness? The questioner assumes it's a debit to PPP loan liability and a credit to equity. If the above is correct, would the credit to equity increase basis in an S corp?
Yeah, great, very great question there. And I didn't mention that, but we have a very astute person on the call. You asked that question because they did as part of the rules there. When you get that loan forgiven, you're taking the loan off the books, and you got your tax-free income, and they do provide in the rules to allow that to count for basis. So from an accounting standpoint, that will count for basis for both partnerships and S corporations, and that'll be a really important part for tax accountants to be able to do properly, because otherwise, if you're not accounting for your basis properly, you're de facto not getting tax-free forgiveness because you're not getting credit in your basis. So I think the way the individual there outlined that would be, yeah, you would debit the loan off, you'd have tax-free income on your books there, but that would also increase your basis. And if you think about partnerships, I would say you do get credits for partnerships for, like, for example, tax-free income. Tax-free income is always going to give you a basis, because if it didn't, in that partnership context, you would not have, it really wouldn't be tax-free because your basis isn't being credited by those amounts. So very great question there, Chris.
Okay. Another one is, can you briefly review what's included in wages for PPP calculations? Are expenses such as disability and workman's comp policies eligible?
Yeah, there's a whole slew of those, and there's a lot of nuances there with PPP, with employee costs, with certain healthcare costs, with making sure that people that you pay have a principal residence in the United States. There were some intricacies with the certain types of state unemployment and things that I don't recall offhand there, but I know, as John mentioned earlier, on the subsequent offerings by Farm Credit coming up here with the PPP, that they're going to go back in depth, very methodically on what counts for PPP wages. So I said, I guess I'll defer the broad nuances there, because I don't want to leave anything out there by omission on accident, Chris, because there are a whole lot of nuances on all types of payroll expenses that are eligible for PPP. So I'll punt a little bit that to next week, and to when John and Keith and Aaron review the PPP program in depth.
Okay, would it be fair to say that some of those sort of fringe expenses are included and some are not?
Yeah, there are some of those. If I recall from the first time, there's some were okay, some were not okay, and I don't recall the specific differences between each of those. Yeah, that's fair to say.
Okay. Question about EIDL loans. Do those need to be paid back? And my understanding is that if you haven't taken a PPP loan, you can get up to $10,000 as a grant. But is that correct?
Yeah, so that's correct. So remember, the EIDL, those are pure loans. So besides the $10,000 grant, those are just pure loans. So those are, besides the $10,000, things that have to get paid back. Now, for people that had issues with the 10 grand, kind of already figuring into some of their forgiveness, the SBA is supposed to be charged with, in the regulations here, making sure people kind of go back and get made whole with that $10,000 if they had that 10 grand. So again, up to that $1,000 per employee per up to 10 employees there. But bottom line, Chris, is that the EIDL is just a loan. So besides the 10 grand, it's a loan that's got to get paid back. Okay.
When you're determining the 25% year over year or quarter over quarter decrease for revenue, do you count government payments in there like CFAP money?
Yes, yes. Gross receipts count everything. Again, as I mentioned before, there's a couple exceptions. One being you would not count your PPP forgiveness, and it looks like you would not count capital gains income as the way the rules articulated today, as far as that goes. But otherwise, CFAP is just it's income that you've received.
Okay. Regarding the sort of PPP round 2, can you apply for that for the round 2 if you didn't apply for it under round 1?
No, you have to apply for round 1 for PPP round 2. But if you didn't apply for PPP round 1, you can apply still, I believe, through March 31st for both PPP round 1 and PPP round 2. So for people that can get PPP round 1 now who are eligible, based on maybe, let's say, the new farmer rules with the 100 grand of gross income amounts, you can apply for PPP round 1, but you have to have applied for round 1 to apply for round 2.
Okay. I have a question here about the sort of related to that revenue reduction question. We are a beverage manufacturer. We do not meet the gross receipts test. By that, I assume that they're talking about that their revenue was not down at least 25%. We were considered an essential business, but our tasting room operations were shut down for 3 months by a state order, and we're still at a reduced capacity, although we have been allowed to make some sales, such as online and to go. What are your thoughts about being eligible for the employee retention credit?
Yeah, great question there, and I think it's worth looking into because the IRS on their facts and questions website, there is a whole section devoted to exactly that, where they go through certain nuances of. In that case, I believe because that person was interrupted with their operations, they're having some pieces modified. That they do. I think you got to work through some of those regulations, but I think it would behoove you to go back and look at those because I think you may be able to go back and get some of that. So you may qualify in that case there. I know the IRS has addressed that, very similar questions like that, Chris, on their FAQ website. So that pretty much similar fact pattern there. So I think the answer is yes, but I would direct that person to work with their preparer, or if they want to look it up on their own, to go to the IRS FAQ on the employee retention credit. And there's a section that says determining whether or not you were shut down. And there's a whole bunch of different scenarios that kind of play off of what that person just asked as far as that question goes. So I think the answer is yes, but I don't recall the specifics, but it is definitely worth looking in and checking it out.
Okay. A question for a clarification of some of what you said here. In regard to the PPP and the employee retention credit, you referred to what you called different wages. What did you mean by that? Different payroll period or different wage rate? Do you remember that?
What I meant by that is, so let's say you have one employee and you paid him $10,000 for the year, but you use that $10,000 as part of what you counted for your PPP forgiveness amount. You can't then get that $10,000 as part of if you are eligible for the ERC. You can't then use that same $10,000 that you use to count for your PPP forgiveness payroll portion for the ERC, for example. But let's say kind of dovetailing off that example, if only $10,000 of somebody's wages was used for your PPP calculation, but you paid them really $60,000, then that $50,000 that you didn't count for whatever reason in your PPP amount would be eligible for the ERC. So you just can't use the same exact dollar amount for both the PPP and the ERC for that same employee. Okay,
thank you for that. Question is, if your PPP is forgiven and was only used for employees, could you now go and make a new application for the self-employment portion?
I knew I guess I don't understand the question totally, Chris. As the question, can you go back and get a second amount of PPP if you've got it forgiven? If that's the question, I think the answer is no. One of the challenges here has been if you've gotten your loan forgiven, and that's why I think Farm Credit East, we've done a really good job of cautioning people on not getting loan forgiveness throughout this whole process and rushing that because the very reason of these rules have continued to change. So if you've gotten your PPP 1 forgiven, let's say already as a sole prop schedule farmer, then you're kind of stuck with having to go back now and get more based on your $100,000 gross. So you would kind of be, unfortunately, in a bad spot compared to your peers who didn't get PPP forgiveness already.
Okay, but if you hadn't gotten forgiveness and you used your PPP money only for employees, I'm assuming that they didn't count themselves, the owner's salaries. Could they go for PPP round 2, so to speak, and for their own salaries?
Yeah. So if you got PPP, well, I guess I would make 2 points there. If you got PPP 1, you could potentially go back and get more refinanced for PPP 1 if you haven't gotten it forgiven. So maybe you can get more PPP 1 based on the gross amounts, and then to PPP 2, now you can get, if you qualify for PPP 2 under the rules of the gross receipts test, for example, you can now use the owner's salary in PPP 2 plus your other stuff there. So yeah, so you can refi PPP 1 if you haven't gotten it forgiven, and you can now use that boost of criteria for PPP 2. Thanks, please feel free to reach out if there's any lingering questions. But otherwise, Thank you for joining us today.